Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Today, we are joined by Head of Quant Index Solutions, Bobby Barnes, to discuss upcoming trends in the market and important narratives in the investing sector. Bobby talks about the latest performance of utilities, such as how they've emerged as the third best performing sector year to date, and the impact AI advancements will have on their future performance. He explores the economy from a macro level and how current consumer trends and predictable CPI data has led to an increase in interest rates. He discusses the impact of increasing unemployment and how discretionary spending has changed since COVID-19. Bobby also looks at key drivers, such as how the US market's focus on high tech and services has factored into bullish earning expectations. Lastly, he advises how to diversify during this late cycle, emphasizing why it's important to focus on maintaining momentum and quality. This podcast was recorded on June 14th, 2024.
We've spoken to you many times over recent months and years about the different factors. It's sort of been nothing but quality, right? I mean, is that about the story, the beginning and end?
Yeah, that pretty well sums it up. When we look at what worked best last year, it was quality, also momentum as well in 2023. And it's funny, the more that I look at 2024, it seems just more of the same. So leadership from a quality perspective is still led by quality. Leadership from a factor perspective is still led by quality and momentum. Similar story where if you look back a year ago, large caps did better than mid caps, which did better than small caps. Well, guess what? 6 months into 2024, large caps are doing better than mid caps, which are doing better than small caps. And for really the same reasons from an attribution perspective, it's being driven by earnings. And so the good news is that we've been in an earnings recovery. Earnings surprise to the upside last year. And in a bullish way, when you look year to date this year, earnings expectations have actually risen, which is very bullish because they typically decline as you progress throughout the year. But as always, things get interesting once you take a peek underneath the hood and see what's driving some of those.
Yeah, what are the drivers here? What are the drivers?
Yeah, so it's
momentum.
So when you look underneath the hood, let's take the U.S. market for example. Earnings are up year to date by about 2%, or 2% better than the expectations at the beginning of the year. But then you take a peek underneath the hood, it's pretty much all driven by tech and comm services, which, by the way, were the same drivers of the earnings last year, a year ago. Again, more of the same. And then similarly, if you recall, one of the narratives from last year was, narrow leadership. And you're seeing that again this year, where I think actually to the decimal, 70% of stocks last year underperformed the broad market indices. Year to date, 6 months into 2024, similar thing. 70% of stocks are underperforming, and what's really being the drivers are the large tech companies that in some way have some leverage or exposure to AI.
So AI, I mean, it is affecting all things, and it's all we talk about. It was kind of the story affecting the utility sector, for instance. I mean, it's made its way through the markets. Do you want to just sort of tell us where you're seeing this happen? I guess, I mean, the sectors are such an interesting way to look at things, but of course the factors cut through that. So maybe you can just kind of speak to that.
Yeah. So what I'm seeing right now is from a sector perspective, when you look at the stocks that are participating with that theme today, it's mostly the enablers. So with your semiconductors, the companies that are building the chips, whether you're talking about data centers, the ones that are housing all of the big data that you need for the AI models to run, and then as you mentioned, utilities, which is actually the third best performing sector year to date. When you drill down to the drivers of that sector performance, there are a handful of utility stocks, which, as it turns out, are providing the incremental energy needs for these data centers. And so they're all wrapped into each other. And then as the way this manifests itself at the factor level is that the enablers of AI they also happen to be, high quality companies. These are very large, very profitable companies. Their profits are accelerating, which as a result kind of puts them also into a growth category in addition to being in the quality category. And so that's, kind of the cyclical and secular drivers that I'm seeing today.
Okay. That's great. I mean, so within the story of soft landings, which is much more of a kind of an interest rate and inflation story, AI is sort of one of the drivers that I I mean, how do you look at it? I'm guessing AI is one of the things that is allowing a soft landing, along with the macro story.
It is, but that's where it gets interesting, Pamela, where when you decompose, because not everyone's participating. And the analogy I've been drawing is that when you look at the headline earnings number for, say, the S&P 500, it's accelerating, and that sounds great. That's otherwise, all things being equal, indicative of a soft landing. But then you lift up the hood and say, okay, well, how many stocks within the S&P 500 are seeing an acceleration of their earnings? And then once you kind of strip out the Mag 7, the AI names, a lot of those earnings are actually down. And so it's one of those strange things where it's the analogy that I was alluding to. It's like, we're having a party and everybody's invited, but then not everyone's being asked to dance while at the party.
Ah, I like that actually. So everyone's being invited, meaning like all companies could participate in this.
Yeah, they could, well, especially when you're looking at the assumption when you're looking at the top line number is that, oh, the average company must be participating, right?
That's it.
But that's not the case at all. And I, when you, especially as you go down in market cap, where as you do so, you get more economic sensitivity. You see that, in fact, in some places, earnings are contracting a bit. And there's a similar narrative when you look at the consumer. You start at the top, the most affluent, the most wealthy consumers. They're fine. They're living their best life. But then you
Yeah.
go down in economic or prospects within the consumer spectrum, and things aren't that great. I mean, they're not cataclysmic yet, but they're not that great. And so those are some of the things that I'm seeing.
So, I mean, we talk a lot about this is the year for stock selection. Stock picking has been a great year for that. You head up the factor story and all the underpinning technology and research that goes along with this. What's the equivalent of saying, okay, it's a stock picker's year? How do you sort of talk about that in factor land?
Ah, a good question. I haven't, yeah, that's something I haven't I've been asked in a while. And typically, when we talk about a stock picker's market, what we mean by that is that there are um, many things that there are many ways, or you get many shots on goal, like and so there are many stocks that are likely to out that um, or have equal odds of outperforming. And so, as a stock picker, you stand a better chance of not missing out. I think you've probably heard people say, something to the effect of, well, if you didn't own Nvidia last year and this year, you're probably not doing well. Like that's the opposite of a stock picker's market, where narrow leadership, you really have to get that one call right. Otherwise, you're likely to be lagging the indices or your benchmarks. And so in factor space, it's kind of a similar story where when there are equal odds of any stock outperforming, that kind of does the same thing with the factors. Actually, in that type of environment, you kind of get more factors working, whether it's value, quality, momentum, low vol, et cetera. But then on the converse side of that, when you're not in a stock pickers market, it's because there's just one or two things driving the market. There's just a few stocks that are expressions of those one or two things. And so when you're looking at your factors, you actually end up having fewer factors outperform in those sort of environments.
That's really fascinating. Yeah. So we come back to quality and momentum.
And we come back to quality and momentum.
I really like that analogy though of the party. On in terms of the economic prospects, this has been a week of incredible economic news, really, and all of it. We're trying to figure out how it fits into the rate story, basically. But what do you watch on this front? I mean, there are pieces of the story that you would watch probably more closely than others. I mean, from a macro perspective, that influences how you do things. How's the economy doing?
So the economy, again, at the aggregate level is doing well. From a macro perspective, some of the things that I'm looking most closely at would be I'm most concerned with the consumer. And so,
Okay.
we've gotten, CPI, we had a softening in the CPI, but the thing is, I think a lot of people are conflating features versus flaws. Like when, that's the exact outcome that you're going to get when you increase the cost of money via Fed interest rate policy. It's going to have its intended outcome. Similarly, the on the but with my focus being on the consumer because they make up 70% of GDP. Um, Part of the reason why we went through this rate hiking cycle was because jobs were too hot. And so the feature, not the flaw, is that by raising rates, you slow down the job market and get some softening there, where there are fewer job openings today than there were a year ago. There are fewer people or temporary employed people than there were a year ago. And the unemployment rate, which is still at multi-decade lows. So don't get me wrong, it's not cataclysmic, but it is ticking higher, ticking higher. And so all these things are illustrative of a job softening, and they're a feature. They are an intended outcome of that Fed rate policy.
Right.
And
It's
so
sort
as I
of a plan. Yeah. But it's happening. Yeah.
Yeah. And so as I look forward, I guess, this is my long-winded answer to your question. Um, the macro things that I'm specifically focused on is um, with respect to unemployment, I think it's going to continue to trend higher. But um, I'm more so about the acceleration. So if it's a slow trickle, that's fine. The economy will continue to percolate on, earnings will go higher, and as a result, the stock market will go higher. But if we get an acceleration at a faster rate on the unemployment front, then that can cause problems. One of the other items I'm paying very close attention to, and I've telegraphed this before, is the excess savings that were accumulated over the COVID pandemic.
Yeah.
Uh,
How are those doing? Are they about finished?
So they're finished. And that's why I'm so keenly interested in them now. Because as I've been telegraphing for about a year now, they were projected to reach exhaustion in June of this year, which we are now in. And so as I look into the back half of 2024, I'm very keenly watching, okay, well, what happens with consumer spending moving forward from here? Because they don't have that extra war chest that they had. Um, they could continue to propel spending by dipping into savings. So, from a macro perspective, keeping an eye on the savings rate, because if that goes down, again, that would be indicative of the consumer stretching to kind of keep that buying power that they've had thus far.
Wow, it's fascinating. So if we go back to just sort of what's worked, which has been quality and momentum, and apply it to the diversification story, equal weight was discussed a lot at the beginning of this year as a form of diversification. Ultimately, equal weight has a bunch of things in it sometimes that maybe if you're looking at the stock pickers story, you don't want some of those things in there. I'm kind of curious about diversification, equal weight. Where do we fit those things into when we talk about factors?
Yeah, yep, very good question, and I obviously have a lot to say there. It's kind of touching on some of my
It's two
peeves.
questions really, but yeah.
So the first thing is this is one of my biggest pet peeves is to always know your bets. Be very explicit about the bets you're making. And so where that pertains to equal weight, because this has come up a lot, people say, and I don't think they're wrong in this. They're concerned about the concentration in the cap weighted indices with, 30% of the weight coming from, just a handful of stocks. But if you use an equal weighted approach as a remedy to that, the bet that I think a lot of investors maybe not do not appreciate is that they're making several bets that may not jive with their actual economic outlook. And so I'll touch on two. The two biggest ones are when you go equal weight, you are betting that smaller cap companies are going to have better economic prospects in the future than the larger cap companies, right? And so what's implicit within there is you're saying, okay, well, all these um, beneficiaries of or the AI enablers I mentioned before, you're actually saying that although they have secular drivers with AI, the smaller companies who don't have exposure to that theme are going to somehow, have more economic strength moving forward. Now, if you believe that, then that's good. But when you break it down the way I just did, I think there are a lot of people that would go, "Oh, I didn't think about that when investing in equal weighted as a way of looking for diversity." The other explicit or bet that you end up making as well is an underweight to tech and an overweight into the smaller sectors like utilities, for example. And so it's a similar thing. Like, do you really believe that utilities, the smaller sectors, be it utilities or telecom or any of the others, are actually going to have future economic earnings power that's higher than tech? And so, if yes, then you made the correct bet. I have no problems. But again, I suspect this is the case that when you break it down the way I just did, that a lot of investors would go, it'd be an aha moment, and they would go, "Oh, maybe I don't actually want to go equal weighted instead of cap weighted."
That's so interesting. Okay, because there's a question here. I'll just you mentioned some of it there. So what is the state of the utility sector in North America, globally as well? Your thoughts. You touched on it there. Yeah.
Yeah, so state of utilities. I mean, it's I find this fascinating because it's utilities normally is indicative when they start to outperform is indicative of a slowdown or a recession,
Expensive.
and so it's kind of odd to be in a market that's up 14% year to date, and utilities being the third best performing sector, right? Um, and so luckily for the sector, they kind of have this they tie to this secular theme of AI. But I will share the following with you though, because I again I like to dig into the numbers here.
Mm.
Um, there are a lot of utility stocks that I've observed that have outperformed year to date. That I call it there is sympathy participation, where they're actually not tied to the AI theme, but because some of their counterparts are, they've actually participated year to date. And so if you are a stock picker, you want to be wary of that when you're going hunting for utilities, thinking that they're all going to participate in this secular theme, because I don't think that's actually the case.
Is it a cap weighted story for them as well? The big ones are trying to transition or at least be exposed to the AI theme as much as they can, or they're working on it.
It's a partially cap weighted. So when I dug down, actually, what I found there was that they're one of the best performing utility stocks to year to date. It is actually one of the largest ones. It was in the top quintile of size within the sector. But then there's one other stock, and I guess I will call out names here, but it's a big beneficiary, but it's actually on the smaller side. It's a little bit smaller than the median utility stock.
Okay. Okay. Really interesting. So, when we look around the world, we seem to be in this world of diversion. This is a macro sort of diversion story. Um, Ultimately, the question is sort of what the diversion might mean in the U.S. for probably different cap weighted companies. Like, what is it going to mean for small caps eventually? And how do you get ready for that, or do you wait for it, or the catalyst story? Do you need to sort of be ahead of the catalyst? We know it's coming at some point. There's going to be a rate cut, or we think
Yeah,
there is anyway.
yeah.
So how do you get ready for that from a factor perspective?
Yeah. So I'm seeing some interesting trends as you look globally, because you mentioned rate cuts. Bank of Canada had theirs. The ECB in Europe also did a quarter cut already, so they're ahead of the U.S. in making those cuts. But I always bring it back to, well, what are the earnings doing? Because echoing back to your question about adding diversification, there are a lot of prognosticators out there that are saying that you should buy, developed international or emerging markets now as a way to diversify.
What do
And
you think? We're dying to know. No,
that
not
that
telling.
also is a trade that has not worked. And the reason, when you dig down to why it hasn't worked year to date and even before that, again, has come back to earnings, where earnings have been accelerating higher here in the U.S. But then when you look in EFA or developed international or emerging markets, those earnings are actually deteriorating. So they've gotten worse year to date than they were at the beginning of the year, and that's driven the performance. That's why those markets are kind of about, call it 6% appreciation year to date, whereas here in the U.S. we're looking at we're closer to 13 to 14%.
So, Bobby, how do investors diversify? Like, what is? I know there's not one formula, but like, what would be some of the suggestions here?
Yeah, so I've mulled over that question for a while now, and I think where I land. Well, let me first start with where we are in the economic cycle. I
Sure.
spend a lot of time trying to calibrate and answer that question. I have my own models, and they suggest that we're still in late cycle. But that being said, we have our asset allocation team, of which Yuri and Timmer, who's
Right.
often on this webcast. He's on that team, and so they've thought much longer and harder about the defining cycles than I. And it is the case that their models have actually switched from late to mid cycle. And so the factor playbook, if you believe that that switch is going to be persistent moving forward, the playbook there would be to actually continue to own momentum, but what you would add to it is value. And so I think it, and from my perspective, and thinking about what factors should I prescribe to my clients if they're looking for diversification. You've heard my reasons or rationales for why I wouldn't advocate for going down in market cap. And so push come to shove, I would choose value, and I might also throw dividend in there. One, because that's just another a way of expressing value. But the other benefit of dividend is that if you when you do get rate cuts, a lot of high dividend paying stocks, they trade like bond proxies. And we
Right.
know that the bond math is they appreciate in value as interest rates go down.
Fascinating. Fascinating to get thoughts from different perspectives. Phil Hills does a great job of allowing different perspectives of sort of exactly that, like how we come to where we are in the business cycle. So that said, is do you what do you think it is? Is it late cycle? I mean, is that sort of your that's still kind of where you are?
Yes, I'm still there. Again, humbly acknowledging that there are other views
Sure.
on that. I where I have the most conviction is that there's some, who might prescribe that we're actually in early cycle. I'm pretty highly convicted that we're just not in early cycle. And with the reason being that you typically need to have what I call slack in the system in order to be in an early cycle environment. And what that looks like is, you go through a recession. There's a lot of layoffs. um, Factories are kind of idled down, so they have a lot of they're underutilized, right? And so that's what I mean by like slack in the system. There's the unemployment is high, so there's a lot of people that can get a job and re-enter. They re-enter the workforce, but then re-enter the economy by buying more goods and services that they weren't otherwise doing. When you look at the thing, like things are really good right now. I mean, we're actually at full employment. Everyone who wants a job pretty much has one, and so the direction of travel isn't likely to be the case where there's that potential energy for companies and new consumers to come back in. So that's how I kind of rule out early cycle. And the mid versus late can be debatable, but I would the way I would I still would stick with late, but I would acknowledge that there has been a little bit of a reacceleration. And so I would say this is kind of a elongated late cycle where you kind of had a backup in economic activity to the upside. But otherwise, the prevailing trend over a longer horizon, which many people have heard me say, I'm always looking 12 to 18 months in the future. I think it's going to be more so characterized as late than mid.
We talk a lot, Bobby, about the all-in-one ETFs, and your leadership kind of has created all the pieces and the strategy to make these all happen. I guess I wanted to ask, how does it sit? How does it end up being sort of these initial blocks in the strategy that we now call the all-in-ones?
I think the value that they provide is there are many ways to skin the cat when it comes to investments. You have some people who are hands-on like me and want to buy each of the individual building blocks and rotate between them at different parts of the cycle. But other people, want to say, well, you've got all your best ideas. Give me a one-stop shop where I can distill the investment decision to fewer levers. And with the all-in-ones, what that looks like is basically the investment decision that you need to make is whether or not you're seeking capital appreciation, capital preservation or defense. So it was kind of aggressive, core, and low risk tolerance. And then after you do that, we've already, with a one-stop shop solution, we've put all the appropriate building blocks, both from a factor perspective, into the all-in-one solution. We've also added some of our best portfolio managers on the bond side in there and allocated to them appropriately. And then you can focus your energy on other parts of either your business, if you're an advisor, or just your life, if you're a retail client. And so that's how we think about the solution that we provided with these all-in-one suite.
That's amazing. Um, what's a wow for you right now out there in the economy? I mean, you're a rocket scientist. I mean, it must be actually hard to impress you genuinely for certain things that come around the corner and get developed and new ideas and so on. So Bobby
Yeah.
Mark, what's a wow out there that you follow, you find really interesting?
Yeah, so I would say my wow is probably not that surprising, just given how topical it is. But my wow has been just AI and the potential. I've got several, as you mentioned, I'm a rocket scientist and have several friends who are rocket scientists, and so we geek out on these things and what they can do, and just the anecdotal stories that have been shared with me where. Someone has been able to ask the AI to write a computer program that does X, and it writes the whole thing. And I've got a whole team of quantitative analysts underneath me to do those sorts of things. But beyond that, I'm excited about the potential, about the innovation that can come out of this AI, where you've got areas like biotech, where people have to map genomes, and it takes a long time to do that in order to come up with a discovery. A lot of that stuff I think is going to iterate faster and have innovations faster that'll go on to cure different diseases and the like. And so I think we're just scratching the surface in terms of what'll be capable with this technology.
And we're going to come back and ask you that again, because you'll be the person to update us on all of this. Thank you for your time and sharing so much about the investment landscape and how you come at it through factors, Bobby Barnes.
Yeah, thanks for having me.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.